Welcome back to the Retire As You Desire show. And boy, I'm so glad that you're here with us today. Every Friday night, we have great new information about retirement planning as far as income planning goes. There's going to be great ideas that you could actually implement in your own life. And that's the whole purpose of the show, is to provide as much value as possible. Speaking of value, in today's episode, I want to focus in on if you've been widowed, divorced, or disabled, and what does that actually mean for your future retirement income? Because this is going to play a big role for your income, your foundation, and really your life planning, especially if you didn't work during your working years. So we're going to go through some great information today, so stick with us throughout the whole entire show. And in part one, I really want to dive deep into what divorce means in retirement, because there are ways to plan for great Social Security income you probably may not have known about. And this is not an uncommon theme when retirees go into retirement. Divorce happens. That's one of the 4 phases in retirement. Once you get into phase 2, sometimes people get divorced. It's not a surprise. It's not uncommon. About 40% of retirees do get divorced in retirement. So it's kind of staggering. And if this has been your scenario, here's some ideas for you on how to cope with that from a financial perspective. So if you've been married for 10 years in retirement, there's some great opportunities to help you plan. But I want to dig deeper in the second part of the show. If you became widowed during your working years or even in your retirement years, I'm going to do a very deep dive into what this means from a retirement income standpoint and how you could try and get more benefits for yourself if this happened to you. I saw this happen firsthand in 2021 when my mom passed away. We had to figure out a strategy for my dad, and this is the same exact thing that I do for my clients. Is we figured out a way for him to have higher income, and we figured out, should he take my mom's income and delay his or take his? So we figured that out, and that's a way that we help our clients as well. And then in part 3, we're going to talk about disability in retirement. And this is something that you could start earlier than 62 when your normal Social Security kicks in. And lastly, in part 4, I'm going to talk about who's excluded from receiving Social Security opportunities. So this is something that a lot of people don't know about, but people are excluded from receiving Social Security benefits. So stick with us for the whole entire show. So I'm going to give you an example for part 1 right now about Robert. This is a random name that's based on a client of ours. But Robert lived a pretty colorful life. He was married 3 times. Yes, 3 times. And each of his marriages, he was married for over 10 years. So it was a very interesting segment. But in his first marriage, Robert, we're going to call him Robert, he met Sarah, but this was his high school sweetheart. They fell in love and they built a life together very early on. And that's how things were back in the 40s, 50s, and 60s. People got married earlier. They had kids earlier. Religion played a big part of that. But as they grew older, after about 12 years of marriage, they started to separate and they parted ways amicably. So they got divorced. Then a few years later, Robert told me he met a new lady, Emily. This was someone who was a great artist. He met her at a gallery opening, so this was sort of a spur of the moment kind of situation. And they had a great relationship. They really did. It was very passionate, very adventurous. They traveled a lot. They went to exotic destinations. They were sort of living retirement early in their 40s and 50s. But they loved art, they loved culture, but despite this, it wasn't enough to help them keep their bond together. And they realized that they wanted different things out of their lives. So they decided to go their own separate ways. And this marriage did last for over 10 years as well. And then lastly, Robert told me this. He's like, you know what? I don't think I'm ever going to get married again. I'm done. I don't want to deal with this. I don't want to go through divorce court again. But he met Alice. This was, I think, his ideal wife, and she was kind-hearted, and they met through mutual friends, so this felt like it was right. It was just the right time. She was more quiet than his past relationships. It was a steady love. They had a lot of respect for each other as well. And on top of that, they loved in just really spending time with her kids and her grandkids, because my client never had children. But throughout their lives, it got really difficult because his third wife got ill and passed away of cancer. They were married for 14 years. So we had 3 different marriages that lasted for over 10 years. But this is part of the difficult part of the Social Security system. Throughout his life, Robert worked. He worked 60 hours a week, he worked very hard, and he contributed to Social Security. However, he was married 3 different times. But despite his 3 marriages, each ending in divorce, and besides the third one, who his wife unfortunately passed away, 2 out of the 3 of his ex-wives, they found themselves eligible for Robert's Social Security income. So they were able to use his higher amounts because they didn't have as much of a benefit at that time. So you could be married 1, 2, 3, 4 times, and your prior spouse, if you are married for 10 years or more, they qualify for a portion or all of your benefits. And then, here's the kicker. This is a very important thing to understand. Sarah, Emily, and unfortunately not Alice because she's not with us anymore. Sarah and Emily, they're in their golden years, and they have a higher Social Security income because of Robert. His financial support has provided higher benefits for his first 2 wives. So one of the little tips that I like to tell people about is that if you've been divorced and you were married for over 10 years, you're gonna wanna call the Social Security Administration and tell them your scenario. Tell them you are married, tell them that you're not with this person anymore. They're gonna ask, naturally, for a little bit of paperwork and documentation, but they'll know because of your tax filings that you are married, and that's how you filed your taxes. And throughout your marriages, even though they ended, hopefully you still have great memories and you're not bitter about some things, but in this scenario with Robert, his first 2 wives, those situations ended amicably. And then just this past year, this was really unfortunate. Robert passed away. He's no longer with us. And I actually had a conversation with his second spouse, and she is able to qualify for his full benefits now. So Robert was receiving about $3,500 a month because he paid fully into the financial Social Security system. So at the end of the day, Robert's first 2 wives are getting his full benefits when they were supposed to be receiving around $1,000 to $1,500 a month. So this kind of describes why the Social Security Administration needs to potentially make changes. Robert's first 2 wives are now benefiting from his benefits and his income, and they're getting higher payouts of $2,000 or almost $2,500 plus a month. And if they each live till they're 100 or more, you see the strain that it puts on the Social Security system? It's really difficult to plan for this because they actually need his higher income. And as far as Robert goes, he found solace in knowing that despite life's ups and downs, the different relationships that he had, he left a positive impact on his first 2 wives' lives. Things ended amicably. But throughout his life, he was a really passionate guy. He really loved his family. He loved spending time with his third wife's children and grandchildren, and he was super charismatic with them. But if you've been divorced, or if one of your friends have been divorced, please tell them about this. This is one of the things that I've seen over the past 15 years, that not all people are educated on this little tip. This could lead to higher income for you, your friend, or a family member. So the whole premise of this rule is 10 years being married, if this is the case, you want to make sure that you're able to figure out if you could have a higher income. And what you want to do is call the Social Security Administration and plan a meeting with them. Bring your financial advisor if you're not sure what to do. If you have a great one, they'll be there for the phone call or your meeting, and they could help you make these tough decisions in difficult times. And there's another caveat to this that I want to make everyone clear on. You have to be at least 62 years old to receive your ex-spouse's benefits. You can't receive them when you're 24 or you're 44. You have to be 62 because that's the beginning of Social Security income, besides disability. Trying to maximize your Social Security income as a divorced individual, it involves understanding the rules regarding divorced spousal benefits and survivor income. And as time goes, claiming your strategy is so important. Make sure you tune in to the next segment of the Retire As You Desire show. Now we talked about divorce. In the next section, we're going to talk about death. If your spouse passes away, you're going to want to stay tuned to this so we could really go into some great information on how you can have a higher income from the Social Security Administration. But if we're thinking about your retirement income and you were the main breadwinner, it's usually, not always, depending on health, but it's usually very important for you to delay your benefits till at least your full retirement age. Here's why. If you delay your benefits until your full retirement age, your spouse, whenever you pass away, if you pass away first, could have a much higher income for their lifetime. Welcome back to the Retire As You Desire show. In today's show, we're talking all about Social Security income. We're talking about divorce, death, disability, some of the 3Ds in retirement, and all about income planning, what does this actually mean for you? If you've had the unfortunate circumstance of one of these 3Ds, I'm really sorry to hear about that. It's really unfortunate. Sometimes a divorce is better for everyone. Sometimes it is. But if your spouse has been lost or someone became disabled, we're going to have great information for you to kind of help guide you throughout this whole entire process. Now, in the last segment, we talked a lot about divorce, claiming strategies, claiming opportunities. I want to touch upon some key points so that we're very clear on how this could benefit you if you're in this scenario. So you can claim Social Security benefits as early as age 62. But if you claim before your full retirement age, it's going to reduce your benefit amounts. It's the same if you're claiming your ex-spouse's income, because talking about your primary insurance amount, your PIAs, if you claim them before your full retirement age, it's going to affect you. But let's say your spouse, if they were younger than you, but you were married for 10 years, let's say they have not claimed their Social Security income yet. It doesn't matter. You can still claim a part of their benefits as long as you were married for 10 years, and you can claim spousal income, divorced spousal income. But they need to be eligible for their benefits, and that means they have to work their 40 quarters, they put in the time, and they worked. So you have to analyze this. But the Social Security Administration is a great resource for you. Now, let's talk about timing your claims and timing your divorce retirement income. If you wait until your full retirement age, you're going to be able to receive 50% of your ex-spouse's PIAs. That's if you wait until your own full retirement age to claim your benefits. Now, you also want to consider your own Social Security income. And this is why it's so important to work with a great financial advisor who's a fiduciary who can help you with these things. Super important. Because you're not going to know your divorced spouse's income amounts, but this is why having your advisor help you work with the Social Security Administration could be a huge opportunity for you to have higher income. Now let's talk about restricted applications. If you were born before January 2nd, 1954, you can use the restricted application strategy. At your full retirement age, you can file a restricted application to receive only your divorced spousal benefits. And this allows your income to grow until 70. They changed this, but again, January 2nd, 1954, these are the rules of the game. Knowing the rules is what it's all about, especially from Social Security income and a tax perspective. And survivor income. If your ex-spouse has passed away and you were married for at least 10 years, you may be eligible for the divorce survivor income amounts. You can receive survivor benefits as early as age 60. This is one of the caveats. Or it could be age 50 if you're disabled. So there are ways to get Social Security income if you're disabled or if you've been widowed before 62. Now, the maximum survivor income amount is going to be 100% of your deceased ex-spouse's benefit if you claim that at your full retirement age. And this is going to disqualify you, so I want to make you very aware of this. If you remarry before age 60, you're going to be disqualified from receiving survivor income based on your ex-spouse's Social Security income record. So, getting remarried may not be in your best interest if you're dependent on your prior spouse's Social Security income, especially if they were the breadwinner, especially if your potential soon-to-be spouse is not financially well off or has not paid into the 40 quarters, or they may be disallowed from paying into Social Security because of their pension situation. So you have to be very careful when you're making these big-time decisions in retirement. So we talked about Social Security income if you're divorced, and we touched a little bit on death and disability. And I really want to focus in right now on how you can get the most out of your Social Security income if you were married for 10 years and if your spouse unfortunately passed away. For a widowed spouse, it really involves careful planning and consideration for a ton of different factors. I'm going to give you an optimal strategy for some people to really understand survivor benefits. And if you're going to be receiving survivor income, these are based on the deceased spouse's earnings record. It's all about your deceased spouse's earning record. The surviving spouse, they can claim benefits as early as age 60. So these are one of the rules that allows you to receive income earlier. But, as I'm sure you could imagine by now watching the show every week, these benefits are going to be reduced if claimed before their full retirement age. It's really important to see if you can delay the benefits until you turn 65, 66 in a couple months, depending on your birth year, or 67. Comparing the retirement income amounts before you make any decisions is a must-happen event. You must compare the ins and outs. These are the things that can make or break your future retirement income. I really hate to say that, but if you become ill later on in life and you don't have enough assets to pay for your medical, it's really hard to have your Social Security cover all of your living expenses. You have to live in a very rural area for that to possibly happen. Now, we talked about timing. The timing of claiming the income is really important. Knowing your optimal age is all about running the numbers. And most people want to know, well, what happens if I only live till 70? What happens if I only live till 80? But also, what happens if you live to 100? We have to plan for all of these different scenarios, and then you have to let your intuition and your health history make these decisions for you, because when you coordinate your benefits, it's really going to come down to the survivor in a lot of cases, because it's very rare that both spouses, leave us at the same time. But if we're thinking about your retirement income and you are the main breadwinner, it's usually, not always, depending on health, but it's usually very important for you to delay your benefits till at least your full retirement age. Here's why. If you delay your benefits until your full retirement age, your spouse, whenever you pass away, if you pass away first, could have a much higher income for their lifetime. So if you're thinking of your significant other, definitely take this into consideration. And then delaying your income till 70, this could be a game changer too in a lot of different ways. If you wait until age 70, this may help you minimize taxes. This is a very strategic gameplay to understand for retirement income. Your Social Security benefits, they can be taxed. They can be taxed up to 85%. So if you delay your Social Security income till 70, you're gonna get a much higher payout, and that's from a reliable source of income. But if you take strategic withdrawals from your pre-tax money, this may help reduce your taxable income. You pay your taxes now, you use those dollar amounts to help offset your income needs if you retire in your 60s. And then, here's the fun part. When you turn 73 in 2024 here in America, depending on when you watch the show, age 73 is your required minimum distribution years. If you use up some or a lot of your pre-tax money first, you may have a very small amount of a required minimum distribution at age 73. And you're probably thinking, why should I do this? Well, if you take your withdrawals from your pre-tax dollars first, this could help offset Social Security taxation and allow that income to grow tax-free, and then also take, hopefully, tax-free distributions from a Social Security income standpoint. So it could lower your taxes in retirement, it could give you a higher income, and it could also help your spouse, if you pass away first and you're the main breadwinner, to have a higher protected income from a Social Security standpoint for the rest of their lives. Now, if your spouse also passed away, in the year that they passed, you may want to consider doing a Roth IRA conversion for some or all of their pre-tax money. The reason for this is you're going to be in a married filing jointly standpoint from a tax filing standpoint. And that way, you have a much more favorable taxation opportunity. You know, it's really unfortunate your spouse is not with us anymore, but your advisor could help you through this process. You're going to have a much more favorable tax bracket for that year and that year only. When you move into a single filing from a tax perspective in the next year, it's not going to be as beneficial for you. So you may want to consider doing a Roth IRA conversion in that year. But again, it depends on your health and paying those taxes, and also if you have kids or grandkids that you want to leave money to. So stay with us. In the next segment, we're going to talk a little bit more about if your spouse passes away in retirement, what to do with your Social Security. And also, we're going to really dive deep into what Social Security disability looks like. Thank you for watching the Retire As You Desire show. They needed help, and that's where the Social Security disability income benefits really helped them out. It helped them from a school standpoint, it helped them from an income standpoint. They were able to keep their house, thank God. Because if not, imagine if you lost your spouse, your son needs medical attention quite frequently and surgeries, and imagine losing your home. It sounds like a nightmare, but these things do happen if you don't have the proper information. Welcome back to the Retire As You Desire show. Have you ever stopped to think about who's actually eligible for Social Security disability insurance? Most people have heard of someone going on SSDI, that's what they call that. But this is a federal program that's designed to provide financial assistance to people who have had unfortunate circumstances happen in their life. I think we all go through scenarios in our life where things are not perfect, things happen, life happens, but if you're one of the people who needs assistance, who are really unable to work due to a qualifying disability, you may be eligible for a Social Security disability income, and it's based on several different criteria. So if you know someone who needs this kind of information, send them the episode. Please send them this. Because if they're unable to work, here are some opportunities for you to receive Social Security disability income. Let's talk about work credits. You must have worked in jobs that were covered by a Social Security income standpoint, and you earned enough work credits. Work credits are earned based on your total yearly wages or self-employment income. So basically, you had to pay into the system. The number of work credits required is going to depend on your age. So it's going to be different from a 30-year-old versus a 60-year-old. But for both of those scenarios, you had to have paid into the Social Security Administration. Now, generally, you need to have earned credits in the last 10 years. So if you took 20 years off, you weren't working, you may not qualify. But younger workers, they may require fewer credits. So if you're 25, something happened, you may be eligible. So you want to look into this. There's also a medical eligibility. So if you've had a disability in your life, you must have a medical condition that meets the Social Security Administration's definition of disability. Here are the rules of their definition. This condition must prevent you from performing substantial gainful activity. The acronym for this is SGA. For example, work that earns above a certain monthly threshold. So if you're making $200 a month, it's probably going to be below that certain monthly threshold. But if you can make $10,000 a month, it's probably going to be over that monthly threshold. You're going to want to be expected to last for at least 1 year or a potential resultant death because of your disability. This is what the Social Security Administration looks at. But they also maintain a list of medical conditions known as the Blue Book. This is something that you can find online if you have a disability. This doesn't automatically qualify you as a disability, but you're going to want to go through the process if you have one of these Blue Book disabilities. Now, let's say if your condition is not on this list. It may not disqualify you if your disability is severe enough and if it's going to prevent you from working. Now, there's also a non-medical eligibility requirement. This is something that you'll want to look into as well. In addition to the medical eligibility, you must meet certain non-medical requirements. You need to qualify for any of these things. So for this scenario, you must be under full retirement age. 65 through 67 is when you hit full retirement age, depending on your birth year and your birth month. You must not be currently receiving your Social Security retirement benefits. And also, you must not be able to perform substantial gainful activity due to your disability. So if you can't work, this is one of those factors. Another thing to consider is you must not have been convicted of certain crimes. So if you're a felon, a criminal, it's not good to do these things, obviously. This may prevent you from getting Social Security benefits from a disability standpoint. Let's talk about the application process for Social Security disability income. You must submit an application to the SSA. This can be done online, over the phone, in person at a local Social Security office, but you'll probably want to make an appointment for that. The application is going to require detailed information about your work history, your medical conditions, and other relevant details. You may also want to have a lawyer prepare this for you. They may be a great benefit for you to help do the paperwork if you can afford this, and may be a great shortcut for you. The SSA is going to want to look at a medical evaluation. So after you submit your application, the SSA is going to review your medical records, and they may request additional information or medical examinations to really assess your disability. They want to weed out any fraud because the program is underfunded as it is. They're going to continually evaluate your condition and make sure that you meet the criteria for your disability needs and under their guidelines. Now, the Social Security Administration has a decision and an appeals process. So if you don't qualify, you could always appeal. But once the SSA reviews your application, they're going to notify you of their decision. If you're approved, you're going to start receiving your Social Security disability benefits. If you're denied, unfortunately, you have the right to appeal, which you probably should. The decision, though, is a multi-step appeals process. Of course, it's not going to be easy. It's going to include reconsideration, a hearing before an administrative law judge, and further appeals if necessary. So it's not an easy process. This is why you may want to hire a lawyer in the first place who specializes in this. You also need to continue your eligibility. If you're approved, your disability status will be periodically reviewed, which makes sense. If you get better, the Social Security Administration doesn't want to be paying out benefits for years and years and years if you can go back to work. Your medical reviews and the evaluations of your ability to work are going to be the main focal points. Now, overall, from a Social Security disability standpoint, it's going to provide financial support to individuals with disabilities who are unable to work. If this is you, we really want to look at getting into the Social Security disability income system, because this could help you maintain your financial stability, and also it could help you get the necessary health care and resources that you may be lacking because of your care. Now, I do not do Social Security disability income applications. I've never done one before, but there are lawyers out there who specialize in this kind of work. Now, your SSDI benefits at any age, if you meet the eligibility criteria for disabilities, there's going to be no specific age requirements to apply. I've had clients who have had children with spina bifida, other medical situations where they needed care, they needed the extra income. One of my clients unfortunately lost her husband at a very young age. Her son has spina bifida. They're the nicest people on the planet, but they needed help, and that's where the Social Security disability income benefits really helped them out. It helped them from a school standpoint. It helped them from an income standpoint. They were able to keep their house, thank God. Because if not, imagine if you lost your spouse, your son needs medical attention quite frequently and surgeries, and imagine losing your home. It sounds like a nightmare, but these things do happen if you don't have the proper information. So please always share this information from the show with the people who you think need it most. It could really change their lives, and that's the whole purpose of our show. Let's get into some of the work credits for your Social Security disability income. This is important because if you're 50 years old and you have a disability, you must have a Social Security income record and earned enough work credits throughout your working year. And again, if you haven't worked in the past 10 years, this may disqualify you, so be aware of this. And generally, you need to earn at least 10 years worth of working credits, but if you're younger, you may not need as many. From a medical standpoint, I think this is the most important part. If you cannot work and if you cannot afford your health care, having the Social Security disability income could be a lifesaver for you. It could really help you get those doctors in your life and the care that you need. So that way, you can hopefully have the best life possible. You're going to want to expect to have at least 1 year worth of a long-term disability for the Social Security disability income amounts to be approved. That's one of the things that we want to keep in mind is this can't be a 2-month or a 3-month thing. This is going to be more of a long-term play from a health standpoint. Now, your Social Security retirement benefits, all of these things are going to be affected. If you cannot have substantial gains from an income standpoint, this is going to affect your Social Security income when you get into retirement, but we need to have the analyzation of income now versus income later versus can I actually work and earn a decent wage, a decent salary, or create a company to pay for my basic living essentials. You need to cover your basis, and the Social Security disability income could be that benefit for you. And don't forget, the approval process, it's not guaranteed. Just because you have a disability, you have to apply for things properly. And if you don't do it right the first time, it may be a long and egregious process to get it actually approved. And don't forget, you're going to have medical evaluations throughout your whole entire time on Social Security disability income. If you really feel comfortable with this, then go ahead and apply for benefits. But this could be the foundation of your lifetime income amounts. As long as you have your disability, things get approved, and you feel comfortable with being evaluated once a year, once every couple years, as things change from a Social Security standpoint. Don't forget to stick with us for the next part and the last part of today's show. I'm going to share with you who's excluded from receiving Social Security benefits. Stick with us on the Retire As You Desire show. So some of the people in the United States who cannot get Social Security income or who don't qualify are teachers. And the reason for this is because of what's called a windfall elimination provision. Welcome back to the Retire As You Desire show. Bill Bloom here, and today's episode is all about Social Security. It's really the foundation for most people's retirement income here in the United States. And in our last segment today, thank you for sticking with us for the whole entire show. I'm going to share with you some of the people who are excluded from receiving Social Security benefits. Probably thinking, I didn't know that people cannot actually receive Social Security benefits. So some of the people in the United States who cannot get Social Security income or who don't qualify are teachers. I'm sure a lot of you know a friend or a family member who may have been a teacher during their working years, but they face certain restrictions on SSI benefits. And the reason for this is because of what's called a windfall elimination provision. When I first started in the retirement income planning space in 2008, I ran into this. I didn't realize this was a thing. Granted, I was 23 years old, I was learning, but I didn't realize that if you paid into Social Security, sometimes you don't have to, but also sometimes you may have a windfall elimination provision. So this is something that I've studied tremendous amounts of time on, because it affects some of my clients' retirement income. There's also government employees. They fall into this situation as well, but they have a different acronym. It's the Government Pension Offset, the GPO. Now these provisions, they can affect teachers who have pensions from employment that are not covered by Social Security. Let's take a detailed look as to how this might work for a teacher and what restrictions they may face. It could really be a huge impact on teachers. As far as the windfall elimination provision goes, your WEP, the WEP affects how Social Security benefits are calculated for individuals who receive a pension from work that are not covered by Social Security. This is true for many public school teachers. This is just how the system's been set up because they receive a pension. And I think teachers are some of the most important people on our planet, so thank you for all the work that you do. Here are some key points of a WEP. You have adjusted income formula. The WEP, it modifies the formula used to calculate Social Security income, and it's going to potentially reduce that income amount by the pension that you're going to receive. You still do have a primary insurance amount, your PIA, and the standard PIA calculation is modified, and it could result in a lower maximum benefit for teachers. And then this maximum reduction, this is the hard part. The reduction due to WEP, they cannot exceed more than half of the non-covered pension amount. So this is where it gets really confusing. As of 2024, the maximum monthly reduction is capped at $557. So the years of substantial earnings are going to really differentiate depending on how many years you teach. It's going to impact the amount that can be mitigated if you have 30 or more years of substantial earnings under the Social Security covered employment. The reduction is gradually reduced for those with 21 to 29 years of substantial earnings. Now, let's say you're a government worker. There are government pension offsets. The GPO affects Social Security spousal or survivor income benefits for individuals who receive pensions from federal, state, or local government employment, and as long as they're not covered by Social Security. Here are some key points of the GPO. You have a benefit reduction. This is going to affect the spousal or the survivor benefit. It could be reduced by 2/3 of the amount of the government pension. Here's an example. If a teacher receives a monthly pension of, let's say, $900, the Social Security spousal or survivor benefit would be reduced by $600, which is 2/3 of the $900. If the spousal benefit is $800, the net benefit would be $200 after the GPO reduction. There are strategies to help mitigate WEP and GPO impacts. Here are some of them. For the WEP, if you're a teacher and have a pension, if you work more years in a Social Security covered employment. So if you accumulate 30 or more years of substantial earnings under the Social Security Administration, this could help eliminate any WEP impact. But it's hard to get both 30 years teaching, 30 years working under your Social Security benefits. If you understand your substantial earnings, you could refer to the Social Security Administration's thresholds to track your years. This is something that your financial advisor could help you with. So if you're exempt from receiving Social Security benefits, you definitely want to look into this. Now, if you're a government qualified employee, you want to plan for reduced benefits. This is the hard part. You want to be aware of how your pension might offset your Social Security income and plan accordingly from a retirement income strategy with your advisor. Alternative retirement savings are going to be a huge benefit for you. Consider supplementing your retirement income with other savings, other investments, or annuities, or bonds, or CDs to help offset some potential reductions from your GPO. Understand your benefits is the key for everything. Your Social Security statements are going to show some of this. Regularly review your Social Security statements to understand how your benefits may be impacted by a teacher's pension or a government pension. It shows it right on your statements. And if you're still confused, you can always consult with the Social Security Administration employee. They have phone interviews, they have in-person meetings. These people could really help you understand your benefits and get professional advice. And when you consult with a Social Security Administration employee or a financial planner who really specializes in retirement income, like we do at Bloom Financial, we're here to help you understand your benefits, because this is really the foundation for a great retirement and a great opportunity to have retirement income last your lifetime. So teachers, other public employees with pensions from non-Social Security covered working needs, they really need to be aware of the windfall elimination provision and government pension offsets. These can significantly affect your retirement income and your Social Security income. Don't you want to know this? Understanding these provisions, planning accordingly, and seeking professional advice, it could help mitigate their impact and ensure a better retirement for not only you, but your family as well, because your spouse may have an impact as well from a pension standpoint. So who's excluded from getting Social Security benefits? Well, most workers in the United States are eligible. The certain ones, like teachers and government employees, they may be limited, but there are ways to help plan for this. Let's look at some other people who may be facing exclusion, or they may be included from a Social Security income amount. We talked about certain government employees. When we look at a federal employee, the Civil Service Retirement System, the CSRS, is all about helping federal employees hired before 1984. So if you're a federal employee and you started work before 1984, and you're part of the CSRS, you do not pay Social Security taxes. So money doesn't come out of your paycheck to go into the Social Security Administration. Generally, you do not qualify for Social Security benefits either because you're a federal employee. However, they may qualify for benefits from other employment covered by Social Security. If you're a state or a local government employee, some states allow for your Social Security benefits to be part of your retirement income. But local government employees, including teachers, police officers, firefighters, they do not pay into Social Security if their employment is covered by a state or local retirement system, which is a pension, which have basically gone away when you look at the workforce. But if you work for the government, pensions are still a thing to be had. They're changing, but they're still in place in today's environment. If you look at short-term and low-income workers, if you work for the government or work for the government for a short amount of time, you may have insufficient work credits. So you may qualify for Social Security retirement income amounts if you earn at least 40 work credits. So that's an equivalent to working for 10 years or more. And if workers who do not meet this requirement, such as those with short-term employment or constantly low-income jobs, they may be excluded from receiving benefits. So going back to the foundation of your retirement income planning, you really want to know if you qualify for a pension or Social Security income. Now let's talk about certain foreign workers. If you're a non-resident alien, some non-US citizens who work for the United States under certain visas, they may not be eligible for Social Security benefits, especially if they do not pay Social Security taxes or they do not meet the work credit requirements. My wife, she came from Argentina in 2014 because of her work. It brought her here, and she was paying into the Social Security system her whole entire time. And now that she's a citizen, she thought she was coming here for 2 years, and we met 6 months after her arrival. The rest is history, but she's been paying into the Social Security Administration for over 10 years now, so her credits are now piling up, and as she makes more money, she's getting a higher Social Security benefit for her future. So that's going to be part of our retirement income plan. Now, overall, some people can get Social Security, some people cannot. The show is all about just giving great information and value for our viewers. So please watch every Friday night, 6 p.m. Central, for more great episodes just like this. Thank you for watching the Retire As You Desire show.